Hey guys, welcome to another one of our videos. The question that I'm going to tackle today is borrowing money when you're self-employed, and really covering that off. And look, the key point here is that banks generally are going to require 2 years worth of good financial statements, and they're going to average your income across those 2 years. So it's not good enough just to have one good year. You've got to have 2 consistently good years if we're going to rely on that income for servicing a mortgage. Now, not all banks are that tough. Some of the banks will be a little bit more flexible around that, particularly if you've got a bigger deposit. The bigger the deposit, the more flexible they're going to be. And the sort of flexibility that we see is, for example, a new startup business that maybe's just gone through its first year of trading. It might not be a full year of trading, would definitely need financial accounts for that first year, but they're prepared to look through that if your accountant can prepare a cash flow forecast for the next year, next couple of years, and then we can put some substance around that forecast in terms of sales figures, deals in the pipeline, that sort of thing. And our experience is if we can demonstrate that, generally we can get a bank over the line. The other sort of thing that we see with self-employed people is potentially tax issues. Now, the problem with tax issues is that banks just won't go there. If you've got tax issues, it means bad cash flow management, and it's a really big red flag for the banks. The good news is that the non-bank lenders are actually really comfortable in this space. So if you've got tax issues, if you're needing to borrow money to tidy things up, but we can demonstrate that you've got good underlying income in the business, then we can finance that through some high quality non-bank lenders. You're going to pay extra for that. You're going to pay probably around 7 or 8% interest rates, but you're only going to have to do that temporarily while things are tidied up, and then we can put you back into a prime mortgage product. The other sort of lending type is, I guess, what you would call a Lowdoc loan, where you don't have financials. And in that situation, that's okay as long as we can evidence the income coming into your business bank account. So as long as we can show, through 6 months worth of bank statements that you've got good cash flow coming into the business, we've got non-bank lenders out there that will prepared to Lowdoc it up to around a 70% loan to value ratio, potentially a little bit higher in some cases. And what they'll do is they'll look at the cash flow of the business. They won't accept financials, but again, you're going to be paying a lot higher interest rate. We've done some loans like that, and look, generally we're just waiting on accountants to get financials done, and at some point in the next 12 to 24 months, you can move that back into a mainstream lender and normal interest rates. So there's a few different options for borrowing if you're self-employed, particularly if you don't sort of fit inside the typical mold that we look at. Hey, talk to you next time. Cheers.